This is our Forex blog for June 15th, 2012, and one of the first things we do every day is we look at our currency meter and we find the strongest currencies to buy versus the weakest ones, and we sell the weakest ones versus the strong. This is our sortable currency meter, which there's the sample one already in our software. You just have to resize it, move it around however you want. This allows you to sort it, and you can see based on the hourly trend, the pound's the strongest, then the New Zealand, then the yen. The weakest two are the dollar and the CAD. CAD's trending down on an hourly basis versus 100% of other pairs. So basically, you'd be looking to buy the pound CAD, buy the pound dollar, buy the pound Swiss, buy the New Zealand dollar, buy the New Zealand CAD. Those are the ones you want to focus on. We've come up with a very easy three-step Forex trading system that most traders should be able to learn in 5 to 10 minutes and start trading with immediately. This is our three-step Forex trading system. Step 1, use a currency meter like I just showed you that shows not only the real-time trend in histogram format, underneath that it shows the 15, hourly, daily, weekly, monthly. The more time frames that line up, the better. You want to buy the strong currencies like today, the pound and New Zealand, versus the weakest ones like today, the dollar and the CAD. Step 2, wait. Too many traders are impatient. They get into trades based on what they think will happen. It doesn't matter what you think. The market's going to do what it's going to do. You're insignificant. I'm insignificant. And most retail traders all added together are insignificant when you're competing against governments and large multi-billion-dollar hedge funds that are moving the markets. So once you find a strong currency to buy, wait for one of our new buy signals to show up. And when price goes 1 pip over the previous bar's high, you buy. Or you can wait for a trailing stop to get hit, flip down below price, and when it turns green, then buy. And I'm going to go over some new things today in class that I haven't gone over probably in 6 months to a year that can improve your odds. Get rid of some unnecessary losses. Occasionally you're going to miss a good trade too, but it's more important to protect your capital. Take the highest probability trades as possible. When you find a weak currency, you want to wait for a sell signal, and then when the price goes 1 pip below the previous bar's low, you sell. And that's a good thing to do if the price is in the middle of the range. If the price is already near the likely statistical lows, then you might want to wait for the trailing stop to get hit, flip up above price, turn red, then sell. So for exits, step 3, inexperienced traders or those with small accounts, 25 or 50,000 or less, should use trailing stops for all your exits. Professional traders and those who trade more lots or even number of lots where you can scale out of trades as they go your way, exit half the trade when it hits the fib target, Fibonacci profit target, or one of these support resistance areas, and then exit the other half when the trailing stop gets hit or the 1.618 fib target gets hit, which probably 70-80% of the time is the maximum profit. And markets rarely ever go beyond the 2.0 fib level. So if it shoots up and doesn't stall at any of these support or resistance areas, goes right to the 2.0 area and stalls, your best bet is to just exit all 100% of the trade. So let's now look at some of the examples. We know that the pound became really strong at 5:30. The 15-minute trend was up. The daily trend or the hourly trend was still down. It shifted up at 8:30. Real time, 15 and hourly, and preferably daily is enough for me to really consider taking a trade in this. You can see the dollar flip down pretty much on all time frames at 9:30 right here is one of the weakest. The CAD was the absolute weakest. But let's look for buy signals in pound dollar pairs, especially after 8:30 or 9. And so there's two entries. When this is below the hourly moving average, it's more likely to go down. When it's above the hourly, it's more likely to go up. One of the things that we look for is when you have a buy signal and price goes above that bar, you buy. You would have had a loss here. You can see it became really strong. Here's another buy signal. If you waited for it to go above the bar here, you're in at 73, out at 19.20. So it's almost a 50 pip move here. And obviously you lose 8 or 9 pips, and then you made 50 pips. If you bought this last one right here, the upper white band usually is where the price starts to kind of run out of steam. You really want to be very cautious up here, but with this kind of incredible momentum, anytime it hits 100 in strength, for 2 bars in a row, usually that trend will continue. It rarely happens. As you can see, it was weak earlier. Maybe you hit 100 for 1 bar, but not 2 bars in a row. It's a very rare occurrence, and it usually means the market's going to continue up. So this was a pretty high probability buy right here. This is lower probability because it's already gone up once, twice, 3 times, 4 times. This is a 5th wave, and it's coming up to the Fibonacci profit targets I do each night, likely to be the maximum high. One thing I like to show now is I look at various statistics on each currency, and the pound dollar normally moves over the last 20 days about 104 pips per day. So you could use that, divide it by 10, and use a little bit longer term range bar. Instead of a 5 pips per bar, use 10. And I'm going to show our volume profile, which we've now enhanced to work with our range chart. This is a 10 pips per bar range chart instead of the 5 pips per bar that we use for entries. And what you can do is add a study that we've had probably for 8 or 9 years, but I've just got them to work properly on range charts now. It's called the volume profile. And this is going to be enhanced even further in the upcoming week. We're going to show the point of control, which is where most of the activity happened on the bar, and the value area, which is oftentimes inside the middle of the bar. This will allow you to, and I'm going to zoom in on it so you can see what this does. This lets you look inside the bar. What is happening inside the bar? These are 10 pips bars. The green is an up closed bar, red is a down closed bar, and obviously, you know, the market can make a higher high or lower low above the open or close occasionally. So, and this basically lets you see where it spent all of the time trading. And this bar right here, there is a lot of activity right here near the low. Typically, value areas in balanced bars can help you find breakout trades, continuation pattern trades, and it also helps you find reversals. For example, this bar here has a lot of activity towards the high end of the bar. It spent more of its time up near the high, came down and closed at the low, the market opened, and it shot up real fast. You know it shot up real fast because it didn't spend any time at these prices. It just, you know, went up here. It spent most of its time during this 10 pips per bar near the high. Now, how you can use this is earlier in the day before the breakout. Let's scroll back. You have this explosion up, and then the market came down, and it spent a lot of time at the bottom, closed back up near the high. You can use this to place more intelligent stops. In other words, if you buy a breakout over the high, you can see that on this bar, it spent a lot of time right there. The previous bar, the most activity happened right here near the high. This is called the point of control. And if you bought that breakout, you could have your stop right here versus underneath the previous bar's low, which is what we typically do. So as I was saying, by knowing where the price spent most of its time trading, and a lot of us use the previous bar's high or low for our stops, or at least the initial stop. If you're initially going to have your stop underneath here at 55.68, knowing that there is a lot of activity on this bar right up here at 72, this bar right here is at 76, you can have your stop 4 pips tighter, and you know this gives you the benefit of using wider range bars, but also having tighter stops. And by setting your range bar based on the number of pips it normally moves per day, the pound dollar moves about 104 pips a day. So this is approximately 10% of a daily move. What I typically try to do is find when a trade takes off, I want to make, my goal is to make 30% of the daily range. So in this case, with the pound moves 104 pips a day, I'm going to use the 10 pip bar. I want 30 pips. So when it goes up 3 times and closes, that's my 30 pip profit. So obviously some moves are much bigger than 30 pips like today, but when you have a trade like this that's taking off, you can simply move your stop up underneath, you know, the activity area. Once it moves your 30 pips, you can have a much tighter stop on the next bar right here. This one didn't really have much activity. This one had most of the activity at the low, so you really got to keep your stop here. This one shot up, didn't have any major activity. If it had a lot of activity near the high of the bar, you could put your stop right up near the high. This bar right here does. It has a lot of activity near the high of the bar, and so basically, as you're watching this, it's already gone up way more than 30 pips. It opens, spends a lot of time up here, starts to go down. As soon as it goes underneath this activity area right here, you want to get out of your trade because you've already made your 30 pips. Once it pulls back, you're in this trade. Most of the activity was near the low, this one, and that's a way that you can move your stop up as the trades take off. And this one right here, most of the activity is at the high. So as soon as it, once you get your 30 pips, if it fails to go higher, you want to get out. If it would have shot up even more, you can trail your stop up a lot better, putting it where underneath where the majority of the time was spent. If it goes underneath that, more than likely it's going to close down and stop you out. You can see this bar right here did come down, went underneath this bar and underneath, or it appears right near the low of the previous bar. One other thing I'd like to show that's been resurrected because I found a cheap source of implied volatility data is the probability bands. These are based on implied volatility from the option prices, and when you go to chart settings, add studies, probability bands, I've updated these to work with the new synthetic symbols that we have instead of E-signal symbols. You just put probability bands on here. And these are very high probability areas where the price usually stalls and reverses at. The first, you'll see 4 lines. The first one is a 65% likely high. The next one's 80% likely high. The next one's 87% likely high. And the one after that's 95% likely high. I'm just going to scroll back and kind of let you see how well these work at predicting highs. Notice to the pip it touched it. The next one, which was the 80% likely high, touched it. That and went a few pips above there. Shorted 55.84, came down 30 pips. Hit it again. It was the high of the day. And I'm just going to showcase this for a couple of the currencies. Here's the euro yen. Notice shot through the first one today, but the low of the day was the 80% likely low. Didn't hit yesterday, the day before. It nailed the 65% high that day. I only have 5 days of data on here. If you can go back longer, here's a euro dollar. Each one has different implied volatilities. This one went to the 65% high and kind of ran out of steam. Nothing else got hit this week in this one. Hit the 65% low, bounced. And a lot of times these levels are near where our 3.0 containment bands are, when it's just one other confirmation factor. And this has nothing to do with our software. It has to do with options implied volatilities, which I update every week. And I've been using this and testing this for the last few weeks and had tremendous luck picking highs and lows of currencies. Let's see the pound dollar today. It's right near the 80% likely high. And it kind of ran out of steam a few pips away from it. Let me add a few more days on here so you can see back farther. So between our normal system that we've been going over, this is just something that's going to be discussed more in class in the future. Notice that gap update hit the 65% high and then hit the 80% high to the pip and fell the rest of the day. Fell from 55.80 all the way to 54.60, 120 pip drop. Notice, and obviously when it gets below the 80 level, that's a good place to look for counter trend trades. Nice little pop here, small profit, decent sized profit. Notice the 80% high to the pip. To the pip, it went to the 87% level a little bit beyond that, came down, hit that level again, came down. And these are just high probability. This hit the 87% low, bounced, double bottom down there, bounced. This one hit the 80% low almost, within 5 or 6 pips. The price is 53.70. It went down to 62. It went 8 pips underneath there. You look for trades to get in, nice bounce. This is a 95% low. Look to the pip. Obviously, if you got into a trade here, you lost. You got into that trade here, you probably made a little bit. Obviously, some days are more trendy than others. But this is the probability bands, and it works on the euro dollar, pound dollar, euro yen, dollar yen, dollar Swiss, dollar CAD. So let me bring up the dollar CAD. I don't think I showed that one. Yesterday it hit the 65% low. Got a nice little 20 pip bounce. If you got into a scale-in trade here, you made money on that one as well. Notice almost to the pip, the major lows. And the reason these work, notice the absolute low here. Boom, boom. The reason these work is, again, they're based on implied volatilities. Those option guys are some of the smartest traders in the world, and they kind of defend these prices. A lot of their option strategies revolve around making sure price does not go outside of extremes. And these levels are, to varying degrees, extremes. So this will help you if you're a counter trend trader or you trade during the U.S. time. Market's already trended up a lot. You want to find an area to do a counter trend trade and have confidence to pull the trigger and the patience to hang on for 30 minutes or an hour while pulls back 20 or 30 pips in the opposite direction. These should dramatically help you, along with our real-time tools. If it's super weak, just wait for it to get underneath one of those levels. As soon as it starts going up, hop on board and stay with it as long as it goes. The key is small losses, big wins.